right, we want to make sure we stay on schedule today, so I wanted to welcome everyone to our webcast entitled Transitioning Your Business. Do you have a plan? With a focus on ESOPs. Thank you for joining us today for this co-sponsored webcast by Steiker, Fischer, Edwards, and Greenapple and Empire Valuation Consultants. I am Tabitha Croscut, an attorney with Steiker Fischer, and I just wanted to do a few administrative announcements before we get started and give people a couple more minutes to join us. First, I just wanted to let you know that if you are able to and want to, you can use the chat feature in the webcast here. If you have any problems during the webcast, feel free to let us know through that chat feature. I have muted everybody's lines so that we don't have to worry about background noise. At the very end of the webcast, we will unmute the lines and try to take questions if there are any. And we will also try to hold all the questions on the chat feature until the end of the webcast, just to make sure that we don't have too much choppiness here throughout. So, so feel free to type in questions or hold them to the end when we unmute the lines. The webcast is being recorded and will be available on both the Steiker, Fischer, and Empire Valuation Consultants websites very shortly afterwards. And we will certainly provide a copy of the PowerPoint here, the webcast slides, at request. So feel free to either email one of us or just let us know through the chat feature, and we'll be sure you get a copy of the handouts if you want one. With that, I am going to start us off here. My name is Tabitha Croscut. Again, I'm with Steiker, Fischer, Edwards, and Greenapple, a law firm consisting of 5 ESOP attorneys. We have offices in New Jersey, Philadelphia, Rhode Island, Vermont, and Boston, Massachusetts. We are specializing in ESOP transactions and handle fiduciary matters, the transaction, the ongoing compliance, basically anything related to ESOPs. 24 hours a day, 7 days a week. So we have a great deal of experience and are very happy to be co-presenting a very basic webcast with Empire. And I'm going to let Chuck Coyne with Empire introduce himself. Chuck?
Good morning or good afternoon, everyone. I'm Chuck Coyne with Empire Valuation Consultants. I'm Managing Director in the West Hartford, Connecticut office, and I've been involved with valuing closely held business interests for about 25 years now, and involved with companies that are looking at the possibility and also setting up ESOP plans for various reasons, many to do with their succession planning. So we have offices in Manhattan, Rochester, New York, Cleveland, Ohio, and an office here in Hartford, and we service the United States. We have ESOPs plans that we do their annual valuations for, and I believe it's something in the 42 different states. So we get a lot of ESOP opportunities. We're really excited about sharing this webinar with Steiker Fischer, who we've had some very good experiences with clients in the formation of ESOPs, and I hope today you learn a little bit about the basics, and please ask any questions along the way that you may have, and we'll try to answer them all at the end. Thank you.
All right, so with that, we will jump right in. Our intention today is to basically give you an overview of ESOPs, what they are, how they can be used, and the agenda specifically is to discuss, just as positioning ESOPs, looking at succession and liquidity planning alternatives to give you a sense for why you should care about ESOPs. Then looking at the ESOP approach specifically as a succession and liquidity planning alternative, we're going to give you some ESOP basics. Chuck's going to talk about the basics of ESOP valuation, as it's a little bit different. He's going to review the ESOP transaction structures using a couple of case studies, and then talk specifically about the advantages involved with ESOPs in the C corporation structure, the S corporation structure, and then we'll round out with the details on ESOPs as a retirement plan tool, and then kind of wrap up and handle any questions. So looking at the question of why should anybody care about ESOPs, whether you're an advisor or a business owner, we are constantly discussing ESOPs with different companies, and the reason for that is because every business obviously has to be sold or transferred at some point in time. And although we've been through some very interesting times, the economic conditions that many companies have weathered well and others have not, but those who have, they have not eliminated the need or desire for the owners to have some liquidity at some point, and certainly they have some succession needs for the ownership of those companies. So the question is always working with the different companies to understand what their goals and objectives are in respect to their liquidity and succession needs, and then to design an alternative that fits those needs. So when we're talking about liquidity and succession of ownership, and primarily in our context, stock ownership, we're usually looking at options involving external buyers, internal buyers, or the one that we don't really want to do, which is liquidation. Most companies are aware of the external buyer option, that is looking to find a third party as a strategic or financial buyer of their ownership, or possibly looking at an IPO. But most companies are less aware of and understand the advantages and disadvantages of internal buyers involving whether that's a family transfer of ownership, a management team that decides that they would like to take on the ownership and run the company and provide owners some liquidity. Whether there's some redemption and buy-sell situations that you see most often in the professional service company area, architect, engineer space, you see lots of redemptions and buy-sell arrangements. And then, of course, the ESOP, which is probably the least companies are the least aware of the options and the advantages involved with using an ESOP. And while we don't expect or pitch to force anybody to use an ESOP where it does not apply, my firm belief, at least, is that every company who's looking at the succession of ownership should be at least considering and understanding what the advantages and disadvantages of an ESOP might offer to them. So as advisors are talking through the options, certainly looking at the options with the external buyers and whether that meets the goals and objectives of particular owners and businesses, or whether the internal buyer options are more appropriate in meeting those goals, we would just like to ensure that ESOP is at least on the table for a couple of minutes at least. So those of you who are on the phone, you're here to learn about ESOPs or learn a little more than you already know. So based on the positioning of ESOPs as a liquidity and succession of ownership tool, we'll cover some of the basics to give you a basic understanding so you can have that conversation with whether it's an actual business owner or with other advisors on how an ESOP might be a useful tool. So hopefully you all know that an ESOP stands for Employee Stock Ownership Plan. ESOPs are qualified retirement plans, and thus I often describe them as very similar to the 401k in the sense that they are regulated by both the United States Department of Labor and by the Internal Revenue Service. They function as qualified plans and thus are required to meet the 401A Internal Revenue Code requirements. But in addition to those requirements that apply in the 401K space, ESOPs have a few additional requirements that, for anybody who is a tax junkie, are found in 409 of the code. They're a company-funded benefit, so unlike the 401K plan, you do not have employees generally contributing to an ESOP. It's really company dollars or stock that is going into the ESOP to fund future retirement benefits. And we always have to pause and make sure that people are aware of the fact that this is not just a tool to transition an owner's stock, but also has future implications with respect to its retirement plan aspects. The assets of the ESOP are held in a trust, just again like a 401k plan, a profit-sharing plan, but the employees do not own the stock directly, and this is one of those ESOP myths that employees actually become stockholders. The shares of the company are held in trust in the ESOP, and the shares are basically used as a mechanism for determining what the employees' benefits are. So whether they have one share of stock allocated, and that's the value in their account. But they don't typically hold stock certificates. ESOPs are intended to be invested primarily in company stock, and that is what gives them the tremendous advantage in providing this mechanism for transition of stock ownership. No other plan out there would provide a company with the tool of buying 100% of a company's stock and holding it for the benefit of employees. And so this is one of the powerful, this is one of the reasons why they're such a powerful tool. Also the aspect of ESOPs that makes them different is it's the only qualified retirement plan that can borrow money. So when you combine the ability of an ESOP to borrow funds and then to use those funds to buy up to 100% of the company's stock, it becomes a very useful tool in the transition of stock ownership. We will also get into, and Chuck's going to talk in more depth about the tax efficiency of the ESOP, which just makes it that much more of a powerful tool. So when you're looking at the different interests that are out there, from the business owner's perspective, the ESOP becomes a buyer of the owner's stock. It really creates a market for the owner's stock. To the employees, it is a funded retirement plan, company-funded retirement plan. They're going to see the value of the stock that's in their ESOP accounts at some future date, assuming they meet all of the requirements for vesting and the like. And to the company, it really is a corporate finance technique. So from the company's perspective, instead of going out there and redeeming shares from departed shareholders, for instance, with after-tax dollars, the company can actually utilize the ESOP to use pre-tax dollars to buy shareholder stock. So it becomes a very useful finance technique for the company. So why are ESOPs so popular to those who know about them? And Chuck is, again, going to get into the details of this. I'm just going to kind of outline some of the reasons why they're popular here. One is there's a potential to pay no tax on the sale of company stock in the C corporation context, and this is what you may have heard referred to as the 1042 rollover. Chuck's going to go in great detail about that. You can have a company that pays little or no corporate income taxes in the S corporation context, and that is certainly one of the major benefits that many of our ESOP clients are taking advantage of, and today there are probably a majority of S corporations with ESOPs versus C corporations, and Chuck's going to get into that. There is this ability to deduct both loan interest and principal that is not found in any other place. So this is where you are getting the ability to use pre-tax dollars in the purchase of the shares from the owners. And Chuck's going to provide a chart showing how that operates. The owner can retain control of the company. This is very different from the other ownership transition tools that I just went over a couple of slides ago. Unlike a sale to a third party where you basically sell your shares and you say goodbye, the owner in an ESOP transaction can actually continue to work in the company, retain control over the day-to-day operations of the company, and in many cases, control of the board of directors, depending on the circumstances. So it is a very intriguing concept to many owners to be able to get liquidity with pre-tax dollars and maintain control of the ongoing operations of their company. And those are aspects that the ESOP can provide. The transaction structures are flexible in that you can sell all or a portion of the stock that is owned by one or more owners. So we have companies that are selling, or their owners are selling 50% of the stock or more than 50% to get a control premium that Chuck's going to talk about, or we have companies that are selling 30% or 100%. It runs the gamut. And following on that is you can sell that stock over a period of many years. So I once had a company that sold in 3 separate tranches or periods. They sold 33% every 5 years to get them to 100% in the final transaction. So it gives a great flexibility in structuring how the cash flows of the company will be used and how the sellers will receive the proceeds from the sale. The employees in an ESOP keep their jobs, unlike the third-party sale where you're never sure if that third party is going to come in and take the customer list and get rid of all the employees. Again, ESOPs allow the owner to maintain control over what's happening at the company, and so certainly in many of our ESOP companies, one of the primary goals was to ensure that those employees who have helped the company to grow and thrive were ensured that their jobs would not disappear when the sole, perhaps, owner decided to retire. And so ESOPs gives many companies this opportunity. And lastly, it's a tool to increase employee productivity. If used appropriately and communicated effectively to allow employees to participate in the ongoing operations of the company, research has proven that the employee productivity will increase in ESOP companies versus their counterparts. So following on from why are they popular, just a quick slide here on why do business owners, why do those individuals who hold the stock use ESOPs, why do they find them intriguing? And I bold the top 3 bullets here because I find that if you are talking with a company or you are that business owner who is looking at legacy, looking at or has a concern for the employees of the company and wants to maintain day-to-day control over what's happening at the company, but you want to transition out of stock ownership, ESOP is probably a pretty good tool for you. These are the 3 aspects or goals that I find are most often present when we're talking to whether it's advisors or individual business owners who are contemplating using an ESOP. So if you hear concepts related to legacy, employee concerns, and control of the day-to-day at the company, ESOP should definitely leap to mind. In addition to those, certainly our owners are looking at diversifying or getting some liquidity for their shareholdings. Of top of mind, obviously, is always avoiding or reducing the impact of income taxes and the question of what do I have in my pocket after the sale. So when you're looking at the comparison of ESOP to a sale to a third party, ESOP is generally a much more tax-efficient means of ownership transition from the tax perspective. It's an additional retirement plan for employees, and that's certainly should be on the list of objectives because at the end of the day, employees will be paid out their retirement benefit in the ESOP. Owners are very intrigued by the possibility of increased employee productivity and providing the ESOP as an employee incentive. Many of our owners are just not ready to go to the golf course or to depart from a company that they've worked at for 30, 40 years. So having the ability to get some liquidity for the stock and still maintain that job and the ongoing operational control of that company is certainly intriguing. And the value and purchase price certainty, the ESOP allows the owners, the stockholders, to figure out what they think is the fair market value based on valuation, hopefully from Empire Valuation, and to say to the ESOP, this is really what we think our stock is worth, can you pay that? So it gives an owner purchase price certainty versus going out into the marketplace and throwing a dart at the wall and saying, am I going to get the price that I want? And lastly, oftentimes there's just no ownership transition alternative for certain companies. There just isn't that third-party buyer. There's no family member in the business to transition the ownership to, and perhaps the management team is not really interested in having skin in the game to throw their own personal dollars at the owner. So ESOP is actually a creation of a market for the shares. And so even a company that doesn't have that third-party buyer can get some liquidity for the stock ownership. So just to make sure everybody knows that ESOPs has been around for a while. This is not a new scheme that we've decided to make up. They came into existence in 1974 with the passage of the Employee Retirement Income Security Act. And over 20,000 companies have adopted an ESOP. Today, ESOPs are covering over 13.7 million employee participants with a whole lot of assets included in the trust of those ESOPs. The average per participant balance is around $67,000, and it's just amazing to work with some of these companies who are really distributing millions of dollars to participants who probably wouldn't even have a retirement benefit with the absence of the ESOP. ESOPs are used in all industries. There are a few limitations, but generally you can use an ESOP in the service industry. Manufacturing industry is wonderful. The engineering and architecture firms can also take advantage of ESOPs. Some states have some limitations, but we definitely have put together ESOP transactions for all of these industries. So there's really not a limit to what can be done. It's really a question of the individual company. And just a quick word on corporate structure, because this is normally one of the first questions that I have when speaking with an owner interested in transitioning using an ESOP. The question of, what is this ESOP thing and how much does it get to say about what goes on? And so just to be clear, I'm not going to spend much time here, it's just to say that the ESOP becomes a shareholder of the company. It does not sit on the board of directors. The trustee does not sit on the board of directors. It does not become part of the officer or management team. And so this is the pre-ESOP structure here. If you look at the post-ESOP structure, the ESOP just simply becomes a shareholder. It has all the rights and responsibilities that a typical shareholder would have. And so a lot of times it's just a matter of describing to an owner what the different roles of shareholder, board of directors, and officers and management are, and that really gets them over the roadblock of losing any sense of control by adopting and using an ESOP. And with that, I'm going to turn it over to Chuck.
Thank you, Tabitha. We're going to just talk real briefly about some of the basics of ESOP valuation. This is just a real brief overview. Obviously, we're not going to go into a lot of detail on mechanics and the methodology, but just kind of point out some of the things that are important to understand. And with ESOP valuation, again, as Tabitha pointed out, ESOPs are regulated by the Department of Labor and Internal Revenue Service, and ERISA and in ERISA there's a term that's called adequate consideration. And adequate consideration is what ERISA and the Department of Labor really are terming as their standard of value. And a lot of you may be familiar with standards of value. The most popular one that we use in most of our assignments, especially for estate and gift tax and any kind of tax purposes, fair market value. Well, adequate consideration is very similar to fair market value, and I'll point out, some of the kind of unique differences that there might be. But for all intents and purposes, adequate consideration and fair market value are very similar. One of the important things to understand, I think, and is not understood initially, is that the ESOP shares are held in a trust, as Tabitha showed you and explained to you. And there's a trustee, obviously, that is in charge of the trust and looking out for the beneficiaries and the participants. And it is under ERISA's adequate consideration guidelines, it is the responsibility of the trustee to set the valuation for the shares that are held or sold to or bought from the trust. Now, of course, the trustee typically is not a valuation professional. They may have some good knowledge of valuation, but what they do is they rely on an independent appraiser or what is considered the financial advisor to the trustee. And the independent valuation advisor is independent, which is important because it can't be someone that works for the company or has a relationship with the company. So if you have an accountant, let's say, that's been doing your tax work or your preparing financial statements, you wouldn't necessarily have them as an independent valuation professional doing the valuation for the ESOP purposes, just like you wouldn't, say, your internal CFO or somebody else. Even if they had some knowledge of doing valuation, you want them to be independent. And then the trustee basically just monitors and makes sure that they feel that the independent valuation advisors received all the proper information, the proper due diligence has been done, and that the valuation was performed in a proper manner. And so the trustee and the valuation advisor every year, the stock needs to be valued. Any time that the ESOP holds closely held business stock, obviously there's no market for that stock, so you have to have an independent value determined on at least an annual basis for plan administration purposes. The trustee and the valuation advisor will go over the valuation, go over what's happened between this year and last year and so forth, and what's going on in the industry and about the methodology, making sure that the trustee is comfortable with the value. And, like I said, adequate consideration is pretty much the same thing as fair market value. And as many of you probably fair market value is really this whole concept of a willing buyer, willing seller, having knowledge of all the facts, and it has to be, as far as the Department of Labor regulations, it should be determined in good faith. It has to be as of a specific date of the transaction or as close to that transaction date as possible. And it should be reflected and documented. It should be fully documented in a valuation report that spells out, all the factors that were taken into consideration, the methodologies that were used, and the assumptions that were made, so that the trustee can understand it. And also, these plans do get audited from time to time, and so the Department of Labor will come in and they'll want to see the valuation report and check it out, make sure they feel it was done properly. Oops, too many here. Factors to be considered in the security with no market is very similar here to if you're familiar with Internal Revenue Code, Revenue Ruling 59-60, which is what the IRS looks for the valuation of assets that have no market. Very similar here, nature and history of the business, whatever specific general and specific economic factor going on at the time. They want to look at different financial conditions of the company, its book value, earning capacity, dividend paying capacity, whether or not there's any goodwill or other intangible value. Are there similar types of stocks traded in the market, publicly traded securities, similar to the company? Is it maybe a good type of methodology to look at the private company that's being valued for the ESOP? Two of the things that are kind of emphasized more in the Department of Labor adequate consideration regulations as opposed to the IRS's Revenue Rule 5960 is that they really mention, more specifically, they want to talk about the marketability of the securities. And that really has to do, some of it has to do with the fact that under ERISA, the ESOP participants, while they're only beneficial owners of those shares, they do have these shares in trusts in their account. When it is time for them to have their shares redeemed from them when they retire, or become disabled, or terminate, those shares are subject to a put right that the company has to, under ERISA, are obligated to. So there is, if you're familiar in many situations with valuation of closely held businesses, especially for, say, estate and gift tax purposes, you have discounts for lack of marketability of these private company shares. If they don't have some kind of a special put right under some shareholder agreement, marketability discounts can easily be anywhere from 25, say, to 35% or more, depending on the facts and circumstances. Typically, because of this ERISA required put obligation the participants have, the marketability discount of ESOP securities, even though they're closely held, are much lower. And typically we see discounts more like 5% to maybe as high as 10%. So there is a difference there. Also, a big factor is whether or not the ESOP actually should be able to pay a control premium for the shares. And we'll see in our example, we are using a control value. What has to happen under the Department of Labor regulations is that you have to make sure that the ESOP trustee, in fact, has control, and it's not just the same old management committee and board of directors are really controlling the company, and the ESOP trustee really has no say. If the ESOP is going to pay control, they should have some kind of a control. They should have control, and then a control premium is proper. And again, if it's not, then typically it's going to be a minority discounted share price that's being paid. Okay. Again, the written report is required. They want to make sure there's some kind of a summary of the appraiser's qualifications. They want to make sure it's someone who regularly values businesses or business interests, especially, and even more importantly, the businesses of that particular type of industry would be good as well. They're certainly, they want to make sure that they're independent of anybody that is involved with the business or the ESOP. We want to set out the purpose, obviously, for the ESOP. You can't use a valuation. Let's say you had a valuation done for another purpose, say estate planning, let's say, or a litigation purpose. You're not going to use that same valuation for the ESOP. It's specifically for ESOP purposes, either for the annual valuation of the shares in trust, or say for a transaction where you're valuing the shares that the ESOP is going to offer to purchase. You want to have a full description of what's being valued, what methodology is being used, what factors are being considered, what the effective date of that opinion is. And again, it wants to be as close to the date of the transaction as possible. Obviously, signed and dated. It's going to be a proper formal report. So you can't have just a summary page. I've heard of people that had like a one-page spreadsheet, and that's not going to cut it if the Department of Labor comes in to look at the evaluation. Again, fair market value, very similar adequate consideration. A price, willing buyers and a willing seller are going to negotiate, neither under any compulsion to buy or sell, and all having pretty much facts about the asset that's being bought. So fair market value, standard, adequate consideration, pretty much the same thing, with those few exceptions where they talk about marketability and control premiums. The process of evaluation, typically there's two main phases of a valuation process, and we're talking about typically here when we have a company that's explored the feasibility of putting an ESOP in place and using an ESOP plan in their design for, say, their succession plan or some liquidity for the owners. Phase one, and these don't necessarily have to be in this order, but you're definitely going to do these different, the different functions. At some point, you're going to have a due diligence meeting. You're going to look, the appraiser wants to go out and a lot of times initially with the trustee and the trustee's attorney. They're going to look at the facilities. They're going to interview management. Typically, we have a fairly comprehensive valuation questionnaire that we send out to the company, and we're either going to get that either after or before that due diligence meeting. It's going to have more additional information that we need to understand about the company and the industry. Meet with the fiduciaries. At some point, you do want to have a meeting with the ESOP fiduciary and the valuation professional, whether that might be the first meeting at the due diligence meeting with the company, or it may be at some other time. And then also, what happens in phase one is typically we're asked to provide a preliminary value, and the preliminary value is such that we're not going to put together the full comprehensive written report at this time, but we're coming down to the value of the company so that the trustee can use that value and negotiate with the selling shareholders and their counsel for the sale of the ESOP shares, or for the shares that are being sold to the ESOP. So it's a negotiation. We provide a preliminary value to give them some kind of a range of value, and then the negotiation between the trustee and the selling shareholders and their advisors. Phase two would mean that after they negotiate the purchase price, and they're going to determine how the ESOP is going to be put in place in the structure and whatnot. Phase two requires that we then take and update the value prior to the transaction, and sometimes, depending on the situation, it could be 2-3 months after the preliminary, or it could be 6 months or 10 months or a year and a half. So it just depends on how the transaction timing goes. But what we have to do is take that valuation that we had in the preliminary value, update it, and then provide an updated valuation. And again, depending on the amount of time that passes, it could change dramatically, or it may not. Typically, when there's a short period of time, the valuation is going to be in that same range of value that was negotiated for the sale price. But we update that valuation, complete the fully documented valuation report, and then on an annual basis, once the ESOP is established, as I mentioned before, because there is no market for the stock, the ESOP, at least annually, needs to have that stock valued so that the participants, when they get their annual statement, they know how much each share of their stock or a percentage of the shares of their stock is worth for that particular year, and they can track that as, again, as their retirement plan. And so for their retirement plan administration purposes, we update that valuation every year. Just real brief, so if you're not familiar with valuation closely held businesses, just a very brief kind of chart here that I like to show what we call the relative levels of relative value. And we talked about, Tabitha talked about, sometimes you might sell to a synergistic or a strategic buyer. That's an option for some people. In some industries, there are synergistic buyers out there, and some of them are paying values that are much higher than a financial buyer could possibly pay. So they're way up here on the value level here. The controlling interest level value is again, that's the value that is able to be paid by the ESOP trustee to agree to that if, in fact, the ESOP is going to have a controlling interest and will have control, in fact, in the decision-making at the board of directors level of the enterprise. So there are different ways to get there. Sometimes we end up at this level here, marketable minority interest level, or as if freely traded level of value, and we can go with a premium for control to get up to the controlling level value, or we might start off, the valuation methodology might arrive at a controlling interest value, and if we're not doing a control valuation, is not a control transaction, we might have to go from that control level down to the minority level with a minority discount. From here, the final actual value that needs to be calculated is typically a non-marketable level value, non-marketable minority level value, or a non-marketable controlling level value. Again, this is going to reference the idea that it's private company stock. There is no market for the stock outside. So the fact that ERISA requires the put option does play a factor into the valuation analysis, and depending on the ability of the company to pay for those put options and being able to have the ability to cover the put option, those marketability discounts are typically, like I said, 5 to 10% range. All right, valuation approaches. The typical 3 valuation approaches that are used for valuing really pretty much any kind of an asset, even non-business assets, whether it's real estate, art, or any other type of an asset. You have market approaches, you have income approaches, you have asset-based approaches. So in the value of a business interest for ESOP or other purposes, we're looking at these 3 different approaches. Typically, the market approach and income approach are the ones that we generally use for an operating business. Asset-based approach, not as often used, except for in situations where the business might be going through some rough times and are having a difficult time with generating profits for a number of years. But we'll concentrate a little bit more on the 2 that are mainly used, the market approach and income approach. Market approach is, something we call a guideline publicly traded company method. This is where we go out, and if it's a company that is in an industry where there are publicly traded companies that do very much similar types of business that the subject company, the ESOP company, is doing, we may want to look at the market prices of these guideline companies that are traded on the open markets and use that as a basis for valuation. We also have the ability to take a look at different databases of merger and acquisitions of companies. Some are public companies acquiring private companies. Some are private companies acquiring other private companies. There's a number of databases out there. We may, in some cases, we can find enough data, we can find good information to use transaction data as either a valuation method or a reasonableness approach to the valuation. One of the main method that's used in many, if not the majority of these valuation of private business, are income approach. And typically this is a discounted future cash flow type of method, or it could be a capitalization of cash flow based on historical earnings. This is just a method where we're looking at what is the future projected earning capability of this company. And once the ESOP is put in place and you factor in any adjustments to salaries that, you may have some retiring shareholders, you may have replacement salaries for retirees, you may have retirees that are taking on different roles and maybe the salaries are affected in certain ways. We're going to go in and we're going to look at what are the future expense levels of the company going forward, what are the future prospects for revenues, and what are the future prospects for earnings. And we'll take an income approach and value the company based on that. That's a real quick view on valuation. I can't spend too much more time on that. We'll be here all day. But just moving along, let's get into some ESOP case studies. I think this is where I think the guts of this program, it'll help you to maybe look at your own situations, whether it's your own company or clients that you're looking at, and maybe you can see some ideas of how ESOP structures can be used and some of the benefits that we're going to go through. First case study we're looking at is XYZ Corp. Has 6 shareholders. Jim is the owner. He owns 60%, so he has a controlling interest. He has 5 other minority shareholders. In total, they own the other 40% of the stock. XYZ is a profitable C corporation. And the value that we came up with on the preliminary valuation for XYZ stock was $20 million on a controlling interest basis. So those are the basic facts. And then what is trying to be accomplished here? Jim wishes to sell his stock to an ESOP, and he wishes to avoid paying capital gains taxes or deferring the payment of capital gains taxes. Tabitha mentioned earlier the Section 1042 of the IRS, Internal Revenue Code, Section 1042, offers this ESOP-specific benefit for C corporations only that allow this deferral of capital gains tax if certain conditions are met. We're going to talk some more about that. Jim wants to take advantage of that. The other important factor is the company has debt-paying capacity, so they're not really highly leveraged already. They do have the capacity to go out and borrow money to buy this stock in a leveraged ESOP. That is the solution, a leveraged ESOP. So here's a schematic of how this kind of very simplistically plays out. And so we'll just trace the steps here. XYZ company approaches several lenders, and a lender steps up with an offer to lend the $12 million under certain terms that are acceptable to XYZ Corp. The lender lends the $12 million to the company, and it's typically done where the lender will lend the money to the company, and then the company will turn around and give the lender its guarantee and its note. Typically, the lender is looking for some kinds of guarantees from the company, assets of the company, and so forth. So they'll have this note with the company and the lender for $12 million. The company then makes what's known often as a mirror loan, but they'll do an internal loan where they'll loan $12 million to the ESOP trust. The ESOP has no other way of getting funds than to have the company make contributions of cash or stock to it. So here, in order for the ESOP to buy Jim's stock, obviously it needs to have a loan between the company itself and the company. The company funds the ESOP, and it's made with a loan. The terms of the loan with the outside lender and the terms of the inside loan, we're not going to get too complicated here, but they don't have to be exactly the same. And if for some reasons we might make them different to make a longer payout period for the ESOP loan to the company as opposed to the outside loan to the lender. But in this case, we'll keep it simple and say they're the same terms. The $12 million cash is paid to Jim, whose 60% shares are basically sold to the ESOP trust for the $12 million in exchange. So now the ESOP is funded with a $12 million loan, and it has in its trust 60% of the outstanding shares of the company. So now Jim has $12 million, and he would normally have to pay capital gains tax on that, when he receives it on the sale. But what we're going to show you is how he can defer that as a C corporation that owns more than 30% of the shares under the 1042 rollover. First, before we get to that rollover example, let's just look at it from the standpoint of the other benefit that's important here to the company, and that is that these notes are tax deductible. The payments on these notes are tax deductible. And what is happening is, as the contributions, or excuse me, as the money, as the principal and interest is due on the note to the lender, the company obviously is obligated to pay that note. But as it's making those payments to the note, it's making pre-tax contributions to the ESOP. It's pre-tax because they're called employee benefit plan contributions or expenses. So the principal and the interest on the loan, in a sense, are both getting pre-tax treatment. Normally in a commercial loan, the principal is not, pre-tax treatment. Principal is after tax, and the interest gets the tax deduction. Here, because we have a benefit plan and the contributions are being paid under a employee benefit plan where we have the ability to expense both the principal and the interest, we're making this in pre-tax dollars. So that the company makes that contribution on an annual basis. The ESOP turns around and gives the company, basically, in a sense, the money back to pay the note to the lender. So the big benefit here, and the big thing to understand about a leveraged ESOP, is that the company is making this payment of the loan entirely with pre-tax dollars, which is something you can't do with any other type of commercial loan. The principal and interest both are being paid in pre-tax dollars. Okay, what happens if the seller decides that he doesn't want to have a loan with a bank? Or let's say you have a hard time getting a decent agreement with a bank and nobody's stepping up with something that's worthwhile. A lot of ESOP structures these days, in the last few years in particular, have had seller financing. And this is where the seller decides to take the note and become the financing source for the transaction. So in this case, we'll just look at a seller finance leverage ESOP. So here we don't have a loan with an outside lender, but Jim basically takes a note for $12 million, he basically sells his shares, 60% of the business, to the ESOP for that $12 million note. And he makes himself the lender. So Jim is going to receive interest and principal on that $12 million note. So he's receiving his, it's interesting, he's receiving his stock at fair market value, and he's also receiving interest expense, interest on that loan. So he's getting a return on he's getting his fair market value for his stock, and he's also getting interest in addition to that. So sometimes the sellers will find that very attractive and would not mind playing the part of the lender. And in many cases, you can also do a combination, obviously, where part of or percentage of the let's say percentage of the $12 million, let's say 50% of or $6 million might be a seller finance type note, and the other $6 million or some other percentage could be lent from an outside lender. So it'd be a combination of both. Again, because we're making these payments, using it with pre-tax dollars is a very effective financing tool for the company. The loan, principal, and interest are both being deductible. And that's what we're saying here. Principal and interest are being deductible. It's either going to be taxed on the seller. The seller's either going to have his principal tax as a capital gains, and if it's in excess of $5 million, the taxes are due right away at closing. Or the next point we want to get to is deferred capital gains tax using QRP, or qualified replacement property. And let's go to that right away here. This is tax-free liquidity to sellers in ESOP transactions. This is one of the areas where most business owners that look at ESOPs many times, this is the first benefit that they really get excited about, obviously because it's a tremendous tax planning tool. First of all, there's certain requirements. The main ones are you must be a C Corp. This is not available to S corporations. You have to reinvest the proceeds in what they call qualified replacement property, or QRP. Qualified replacement property is basically stocks and bonds of U.S. domestic companies for the most part. Certain types of investment property is not qualified. We're not going to go into too much detail, but things like mutual funds and things like that are not qualified. But basically, stocks and bonds of U.S. domestic companies will qualify. The ESOP, again, must own 30% of the company at the time of this election for the tax-deferred rollover. Now, that in Jim's case, that won't be a problem because he's selling 60%. In other cases, it could be two shareholders that own 30% combined that sell, and they both might have the ability then to do a tax-deferred rollover. Minimum of 3-year holding period. If the company were to sell the stock of the company within 3 years after the transfer, you have a penalty tax, 10% excise tax. You have to, if you have more than one class of stock in the company, the highest form of stock, let's say you have voting, non-voting, the highest form of stock, the voting stock, is what has to be sold to the ESOP to qualify. You have 15 months to reinvest the proceeds. 15 months, 3 before the actual transaction, 12 after the transaction. 3 before means that if you know you're going to do this transaction, it's just a matter of time. You do have the ability to take and elect to take some of your own funds. You might have setting aside in some other account. You take some of those funds and actually reinvest that and qualify it under the 1042 rollover as qualified replacement property 3 months before the transaction. Okay, again, there are rules on what is eligible, what's not. Here's a list of them. I won't go into detail. We'll move along a little bit here, but you can see it's mostly stocks and bonds of domestic U.S. companies. And there's some, qualifications here for what's eligible. Okay, so let's just look at unlocking this QRP. Here's another thing to consider. One of the strategies is really an active management strategy, as opposed to just buying and holding a portfolio of qualified replacement property with your funds. A seller might decide to be more involved with an active portfolio management. And what I mean by that is, by taking the $12 million, Jim could go out to the marketplace, and there's certain bonds, floating rate bonds, that are available by major corporations that are designed specifically for this 1042 transaction. What makes them unique is the fact that these bonds typically are non-callable. They mature in 40 or more years, and they're floating rate. They have a floating rate note, a coupon usually indexed to some kind of commercial paper. And so you can take the $12 million from the sale of the stock, elect this 1042 rollover treatment, buy this bond, and that is now your qualified replacement property, the bond. So you've now unlocked this QRP in a sense, because now you can take that bond, and typically when you're working with a broker where you're getting a bond, they're going to allow you to margin 80 to 90% of that, and 80 to 90% of that $12,000. In this case, 90% is $10,800,000. Now, Jim could take that $10,800,000, and he's unrestricted in how he uses it. He can go ahead and buy stocks and bonds of businesses and types of bonds and investments that are not qualified under the QRP rules, or he can take some of that money out and, for other purposes, buy a boat or whatever he wants to do, and he won't trigger the capital gains tax because, again, that floating rate bond is the qualified replacement property. As long as it doesn't liquidate that floating rate bond or that bond doesn't get called, the 1042 deferred capital gains treatment is maintained. So there's a kind of a way to be more active in the way you use your qualified replacement property. One of the things to understand also from the estate planning context is the benefit that if Jim holds that qualified replacement property until his death, it receives a stepped-up basis, and you avoid paying capital gains tax entirely. So, or any portion of that QRP that he retains until his death will get that stepped-up basis at that, and you'll avoid paying that capital gains tax. This chart here shows you the power of the tax savings we're talking about here. And I'm only talking about the federal rates here. Now, other states' rates will be combined to this, and they're all a little bit different. So we're just talking federal here, but if you have state capital gains tax rate, it's in addition to this. In 2012, the capital gains on long-term capital gains rate on sales of securities at 15%. Now, we know that the Bush-era tax cuts are scheduled to retire in 2013. In addition to the fact that the capital gains rate is going from 15 to 20% in 2013, there's also an additional 1.2% tax that's part of what's known as a disallowance for itemized deductions on income earned above a certain threshold. So you get an additional 1.2% because of that disallowance of itemized deduction. In addition to that, you have another 3.8% that's going to be in effect in 2013. That's part of the new federal health care program. So now the actual total long-term capital gains rate is not going to be 15, it's going to be 25% in 2013. That's an increase of 66 2/3% in the total capital gains tax rate. It's a huge increase. So I think we're going to see more and more business owners really finding this tax-deferred rollover option even more attractive with this higher rate. And you can see here in our example, we had $12 million sale proceeds. Let's say you had a basis in the stock of $2 million. So we had a long-term capital gains of $10 million. In 2012, you would have saved $1,500,000 in capital gains, or deferred $1,500,000. In 2013, that's going to be $2,500,000. So it's a huge, huge benefit and a much bigger difference. We talked about paying off the loan with pre-tax dollars. Well, what does that amount to? Well, if you consider a corporate tax rate of 34%, that $12 million loan being paid back with principal and interest being deducted gives you over $4 million benefit because of the tax deductibility of the loan. Add that to the capital gains tax savings, and you're looking at, in 2013, something in excess of $6.5 million of tax savings, or 54.8% of the transaction price. So, I mean, it's a huge ability to get some favorable tax treatment. We're going to quickly just talk about S-Corp ESOPs. And in 98, they became eligible for ESOPs. There's some unique differences between the S and the C Corp. The main one being that they aren't available to have the tax-deferred rollover like the C Corp, so they can have a 1042 rollover. But the main advantage of an S Corp is whatever percentage that the S Corp ESOP owns, they don't pay federal income tax, or in most states, state income tax on that percentage owned by the ESOP. So any earnings that flow through, S corps that flow through companies, that earnings that are flow through to the ESOP do not get taxed. So what we have is many, many ESOPs that are S corps today that are 100% ESOP-owned companies, and they are not taxed at all on federal income tax. So it's a huge advantage for a business to pay no federal income tax, and in many cases no state income tax on the ESOP, on the earnings flowing through to the ESOP. So I know that was quick. I hope it was clear. I know Tabitha is going to finish up with some ESOP as a retirement plan benefits here.
Thanks, Chuck. So I think we've come up to 1:30 here, our cutoff time. We have just a few more slides, so if you have a few more minutes, I'm not going to cover all of these. They will certainly be available. But I just wanted to actually take you quickly through a couple of them. We talked originally when we started out the webcast talking about the ESOP as a retirement plan. And so a few of these slides have to do with those features of the ESOP. Just to note that there is an allocation formula within the ESOP for allocating the benefit or the shares to the accounts. The vesting period is very similar to the 401k context. Again, that's with a 3-year cliff or a 6-year graded. And there are some differences that are designed because of the ESOP being an owner of stock. There are differences in the distribution timing from what you would be used to in the 401k context. So those are important to take note of. Just the final few slides here are just important for understanding what companies are the good candidates, what companies aren't, and then just a few steps as to if this looks like a feasible option for a company, what they should do. So the best ESOP companies, I would say, just as a general rule, are companies that you could sell to a third party that are not in bankruptcy but are profitable. They're growing. They have the ability to take on some leverage. They can finance their own growth. Certainly, if they have good financial reporting, that makes the transaction much easier. And they have a deep and broad management team, because remember, the buyer is not an individual that can run the company. It's an ESOP, and so the ESOP has to be sure that there's a team in place to carry on the company's growth and profitability. I also wanted to mention we did have a question on the size, either from a company value size or revenue amount for ESOP candidates, and I'm going to save that for a minute because I want Chuck to comment on that as well. So just let me finish this up quickly. Situations where you probably should not be thinking ESOP, again, when you don't have a successor management, where there's no one that's going to be able to push that company ahead. If the seller is the management team and when he or she leaves, the company is just going to fold, that is not a good ESOP prospect. The owner only wants a few people to own the company. This comes up a lot. I want my key people to own the company, but I don't want to share ownership with all the employees. That's another situation where you probably are not thinking ESOP. There may not be enough employees to SOP. There is a situation in the S corporation context. There's a test that requires basically a minimum of, I'd say, 15 to 20 people in an S corporation. In a C corporation, you're generally fine. There's no real minimum. It's just a question of whether you're getting sufficient tax advantages for the expense of the ESOP. And lastly, the owner's price is opportunistic. If you have an owner who is looking to maximize value, going back to the slides that Chuck covered, we're talking about fair market value, and there's a limit on what the ESOP can pay. So if there is a third party out there that can pay a very nice premium for the stock, then that company may not have any interest, or that owner may not have any interest in using an ESOP, and that's fine, because the only thing that the ESOP can pay is that fair market value. And then just a quick slide on the steps involved, and Chuck really hit upon quite a few of these in terms of if you're looking at using an ESOP, best practice here is to do some sort of feasibility analysis or transaction analysis so the company can really look at what does this ESOP thing look like long term to the company's cash flows. Then you're talking about the financing. Will a bank lend the money needed for the transaction, or are you talking about seller financing? And then once you get past those couple of questions, you're talking about calling up Chuck to give a valuation to the trustee so you can move on with the transaction. Legal counsel drafts the plan documents, and the company would be designing the plan. And then the legal counsel will do all the documentation. This is just like any other third-party transfer in terms of a stock purchase agreement, loan agreements. There is due diligence that is very similar to what you would see in a normal third-party scenario. And then you get to closing and you file the plan with the IRS to get a favorable determination that the plan is in fact qualified under 401A of the Internal Revenue Code. So those are the quick steps, and with that, I am going to unmute the lines. And I just wanted to bring out one
The conference has been unmuted.
So Chuck, we got a question early on that I gave a quick answer to, and that is a question on what company value or revenue level makes it worth considering doing an ESOP in light of the expense of setting it up and maintaining it every year. And just so you know, my response was, my rule of thumb is a company that's valued around $3 million is on the low side. And it really is at that size of a company, it's really a question of looking at the feasibility of the ESOP, and it's dependent on whether the tax benefits that the company will derive from the ESOP outweigh the expense of the ESOP. So I don't know if you have a different rule of thumb in terms of value or revenue size.
Yeah, that's a great question. It's a tough one to nail down because there's so many moving parts to it, and it really just again, it goes back to having a feasibility or a transaction analysis done, because I would agree with you. If you're looking at companies that are less than $5 million in revenue, you start to become suspect of whether or not they're going to be good candidates for an ESOP because of expenses of setting them up. Now that can vary though, because again, you got to look at the tax benefit. And if you have a very profitable company that is small but extremely profitable, the tax savings still can be quite substantial. And again, it depends on what you're doing. If you have an S corp versus a C corp, and whether or not you're doing outside financing, or if you're doing a seller finance, or even a non-leveraged ESOP. So all those factors really have to be looked at. And again, a good transaction analysis feasibility study will help you determine just what the benefits are going to be versus the costs. And that's really the only way to do it, although like you said, I think if you're looking at a $3 million or lower revenue company, the likelihood is one that it'd be very difficult to justify the expense of setting up and maintaining an ESOP based on the benefits.
Are there any other questions people just want to shout out?
We wanted page 31 put back up there. Let's see.
Right page.
There we go. You mean 30?
I'll add a few of the other questions that were good ones asked were, can an LLC use an ESOP? And the answer is you can't have an ESOP with an LLC, but what we do often have LLCs that we convert to corporations, or you have a few LLCs and you establish a holding company and you do the ESOP transaction with the holding company. So even though a company is an LLC, that doesn't take them out of the running.
Yeah, another good question was asked about what about the value or revenue levels and worth for setting up an ESOP in light of the expense of maintaining it in every year, not just the setup. The initial setup, obviously, a transaction, you have lending costs, you have lawyers and valuation and accounting, and the transaction, obviously, there's some expense there. And I think the question was, what about on an annual basis? And this is where I think there's some misconception. On an annual basis, it really isn't that expensive to maintain the ESOP plan as compared to, say, other defined contribution plans like a 401k plan. Obviously, you have administration costs, you have record-keeping costs. And many companies, most companies, in fact, we often suggest that they maintain both their 401k plan and have the ESOP plan. So that record keeper for the 401k plan, sometimes you can find record keepers like SES Advisors, which is a record keeper that can maintain both your 401k plan and your ESOP plan, where the cost really isn't that significantly higher. And then you have the cost of the annual valuation, which on an annual basis being updated is much less than, say, the initial valuation. So, again, it's not too difficult to look at the feasibility from an annual expense basis versus that first transaction and how much you're spending to get the ESOP put in place.
Any other questions? I don't want to keep you too long. All right. I just wanted to make one final note, which is, as you can tell from going through this webcast, ESOPs are their own special animal, and it's not an animal that every professional has a great depth of knowledge about. So we would just say, to the extent that you yourself or you have a owner that you're working with that is interested in ESOP, just please make sure that they are using ESOP professionals who have done more than a handful of ESOP transactions, both on the valuation, the legal, and the trustee side of the transaction. The last thing we want to hear about is a company who was using counsel or a valuation firm that didn't know what they were doing, and then they end up coming to us to fix it. And while we love to fix things, we'd much rather do it right the first time. So please make sure that you're using experienced ESOP professionals in your transactions. So, Chuck, any final words?
Oh, I think hopefully, like we said at the beginning, you can get the slides if you want. You could also go to our websites in hopefully just a few days, and if you want to re-listen to parts of it or the session over again. Hopefully, it provides you enough basic information to know whether or not an ESOP is something that you want to explore with either yourselves or your clients. And obviously, the next step is to call in ESOP professional, come in and take a look and further educate what kind of transactions and structures are possible and look at the feasibility of it. So I just hope, this, again, I think part of the mission is to get the education of what ESOPs are and how they can be used. There's a lot of misconceptions out there that we try to every day educate people on really how they work. And I hope that we were able to accomplish that today.
All right, well, thank you for your time. And Chuck, thanks for co-presenting.
Thank you, Tabitha. Have a great day.
PremiumBeat.com